It's been a long time since I've worked for a Christian person, and for many years was working in definitely non-Christian environments, so a lot of swearing and people getting yelled at and people trying to schedule conference calls for Sunday mornings, which I always refused.
He wishes that.
So now with Paul, it's been great. If you don't know him, he's a man that truly lives out his faith and is genuinely a kind and caring and person that wants others to succeed. So it's been a great 9 months or so far. Yeah. So it's been a very nice change. So as Paul was alluding to, I'm also a brother in the faith. I belong to the Lutheran Church Missouri Synod. There's a church down in Eastern Market, Historic Trinity, that dates back to 1850, I think. So my family and I are members there. And also live in the city. I'm very pro-Detroit, trying to do my bit to help bring it back. So I have a wife and 3 kids now, and we live in an old English tutor that we're restoring, still not done. I am not licensed or a financial advisor. I'm in finance with, what, the next slide? Not an investment advisor, but I'm in finance and have always, ever since I was a little kid, been super interested in stocks. I think when I was probably like in 1st or 2nd grade, every Sunday when we got the Detroit news, I had a little log of stocks for whatever reason I was following, and I would write down the prices and track those. And a couple years later, my grandparents somehow transferred to me some shares of Pfizer, which was a great gift. And then we found out that you apparently have to be 18 years old to own stock. So Pfizer figured that out somehow and wasn't too happy about it, but they let me keep the shares. And over the years, I've just read dozens and dozens of books and tried out all the major schools of thought with investing. So your traditional buy and hold, swing trading, day trading. Last year, I came across and really grabbed a hold of stock options. So if we have the time, we're going to actually have an introduction to that too, which sounds scary, but it's not. So that's been something I've been really into for the past year or so, and have been learning a lot about, and got Paul to even try his first covered call, so he's I pushed him into it a little bit. But as far as what I'd love to do tonight is to, at least if you haven't gotten into investing at all, pique your interest and kind of point you to some resources for further learning, because there's obviously a lot of content around investing. But it's such an important thing to not only build wealth, but financial security, save for retirement and other major financial goals. But you need to be careful about how you go about that, and obviously not risk too much. So hopefully that's kind of what you had in mind as well for what we're here to talk about tonight. So first off, I'd like to give an introduction to securities and stocks and how some people approach them. And that would be sort of like a 101 course, if you will. And then if we have time, we can get into some stock options, which would definitely be jumping a couple steps, I think. But if I could at least maybe get you interested in them to learn more, that would be a big win in my book, because I think they're a lot of fun and it's a whole new world. So I don't like to hear myself talk, so please, as we go, ask questions and let's make this a discussion. So I know a lot of you in the audience are involved in investing already, so if you wanted to chip in on anything, that's great as well. So as far as the introduction to stocks, just starting at the square one, the very basic, what is a stock? And there are many, as you probably already know, as a lot of you are business owners, there are many different legal types of businesses. So you have LLCs, LLPs, S Corps, C Corps, partnerships, and so forth. C Corps are a type of entity, a type of business. The majority of the big names that we all recognize are this particular type of business. But what this allows for is for people to buy little pieces of them, buy individual shares. So that's what you're actually doing when you're buying a share, is you're actually becoming a part owner. So I think it's hard to even think of a major business that's not publicly traded. There's a small number of them, like Cargill, I think, is one of them, but there are not many. And because there are so many, there's actually thousands of them traded on NASDAQ and the New York Stock Exchange and some of the other exchanges. People will categorize them to better wrap their minds around them. And the section here, this middle part here, these are just a few ways, a few of the major ways that that's done. So people will look at the size of the business, and how they do that is they calculate what's called the market capitalization. So that is the total value, not of the revenues of the company, but rather the total value of the stock of that company. So if you had a $100 share of stock and there were 10 total shares, the market capitalization for that business would be $1,000. So that's how they bucket them in terms of size. The main three categories are large, mid, and small cap. And that's kind of the generally accepted threshold or definition of those. So if it has a market capitalization of over $10 billion, it's considered a large cap company. The larger the company, generally speaking, people consider those to be safer bets as opposed to a much smaller company that might fluctuate more and be more at risk and maybe not have as diversified of a customer base or geographic area or whatever the reasoning might be. There are also subsets of each of those. So there's one that's actually called very large cap. There's a micro cap. So there are variations to those major categories. Sectors of companies as well. So if you look at this graphic here on the right, this is actually from a really cool website I like to point you to that's referenced in the source called finviz.com. It's a website that's free that you can use to scan and screen what's called screens for stocks. So if you wanted to look at large cap stocks in Europe that are attractively priced or have a high dividend, you can actually do that, and it's all free. But this is a map of the stock market where the bigger the box, the larger a larger proportion of the market that represents. So you'll see that there are subsections to this. So here's consumer goods, financials, and so forth. And then within each section, there are little boxes of individual stocks. So you'll probably recognize some of the names, like the top left is Google. These are the symbols, they're called the stock symbols of these different companies. So if you were to go to Fidelity.com or any other platform or brokerage, whatever it might be, TD Ameritrade, there's a bunch out there, and type in K, it'll bring up that stock there. And this is all color-coded. Just as FYI, why it's all red, this was pulled on a very bad day in the market. So the brighter the red, the worse the day that company had. The brighter the green, the more it went up. So almost every single company in the entire exchange was doing pretty poorly that day. But you'll see that the major sectors there and how much of a market they have. There's also themes. So people will approach investing differently. There are companies that they'll bucket as growth companies, so companies that might not necessarily even have much profit today, like Tesla, for example, but that people think, this is a high-tech company with big prospects, this is going to be a growth market going forward. Value investors or value stocks might be your more traditional big companies, GE, GM, Kimberly-Clark, and those type that you're not going to expect them to have astronomical growth, but they may be attractively priced or have a nice dividend or something. So that would be what someone would potentially consider a value stock. Other people will categorize stocks based on yields or the dividend yield. So for our $100 share example, if that company gave a $1 per share dividend every year, that would have a 1% yield, which would be on the lower end, but people would sometimes look at stocks just based on that alone. So that's another way that they're broken out. So that's how the companies are bucketed. But as far as how you could bucket and categorize the people that are involved in investing, you have a few types there. So we have long-term investors, and that's what I would say most people are just by default. They'll buy a mutual fund or buy shares. If I would have kept those Pfizer shares, for example, from my childhood and just held them for life, that would be kind of a typical investing approach, a long-term investor. or you buy and then maybe in retirement you would eventually sell to spend that cash. Swing traders are more active, so you might, instead of holding a share of Pfizer for 40 years, you might hold it for 3 months, 6 months, 9 months. They have a bunch of ways that they use to try to time where the market, if you have ever seen and we'll look at a graph of stock prices, it'll kind of go in waves or up in different angles, and they'll try to time peaks and valleys and get in and get out appropriately. So they have a bunch of tools that they use, but they're much more active than your typical investor. Then you get all the way to the other extreme of day traders who may hold a position or a stock for seconds or at most overnight. So they're in and out very, very quickly trying to catch or scalp those, they'll call it small movements in stock prices. Any questions so far on just how we look at the market in total? And
I'd be curious to see what a market sector map looked like maybe 20 years ago or 40 years ago.
Yeah.
Before IT was.
Yeah, that would be interesting.
Such a big box.
Right, absolutely.
Maybe utilities was big, or maybe there was another box there.
Yeah, I'm sure the auto companies would have been a much bigger share. Yeah, industrial goods would have been huge, I'm sure. Yeah, and here utilities is just that bottom little corner. So, and it's interesting to look at some of the larger boxes on here. So you have companies like Amazon that barely makes a profit, and they're one of the biggest boxes on the whole graph. So, and then you compare that to companies that have been around for 100 years that are solidly profitable, and the market just doesn't value them as much. It's interesting. Any other questions or comments? Yeah.
Out of curiosity, are all of the sectors on there, or are there other ones you didn't include?
Well, that's how that particular website breaks them out. There are more, and probably you could break these out in a number of different ways, but that's, I think, at the highest level, probably how that would be done. Anything else? So the decision has to be made. If you wanted to invest, or you already are investing and you wanted to maybe reassess your positions or put more money into the market, what do you actually do with your money? What do you put your money into, and where do you sink it? So a few of the options, and this is not by any stretch all of them. For example, bonds, you'll notice, are completely missing here, but individual stocks would be like all those different boxes that we saw in that prior graphic, so that's pretty self-explanatory. But if you were to say, put all your savings into a single stock, that exposes you to what's named on there concentration risk, or a single sector, or not diversified to any extent or to a small extent. So for example, say you put your money into like a pharmacy type business, even CVS. I have stock in CVS, and a couple months ago Amazon announced they were going to get into drug distribution and selling there, and CVS tanked. If I would have had my entire retirement in CVS, that would have hurt badly. Or if you have a pharmaceutical that they had a lot of money, a lot of stuff riding on a particular drug getting through FDA approvals, and it wasn't, that would hurt badly as well. Bristol Myers Squibb, who we have some stock charts in here coming up, actually had that happen a couple weeks ago, where Merck and Bristol Myers on the very same day were announcing the trial results of a drug to treat the same type of cancer, and Merck's was better than Bristol Myers, so Bristol Myers tanked like 15% over a few days. So if you were concentrated in one single stock, a piece of bad news like that could really hurt. And vice versa too. If you had a stock with amazing earnings results, for example, that would go the other way, but it's a gamble. So unless you purposely spread your money out, just like on roulette, if you spread your chips out over a large number of numbers, that would be safer than putting them all in one stack. A way to get instant diversification is through the next two options, so mutual funds or ETFs. ETF is an acronym for exchange traded funds. Most people think of them as being very, very similar, and there are a lot of similarities, but we'll look at some differences in a minute. But by buying a share of a mutual fund, for example, you are instantaneously getting even smaller shares, little bits of shares, of dozens or hundreds of underlying stocks that make up this basket. So that's a way very cheaply to diversify. You don't have to buy one share of every company on the S&P 500. You can buy one share of some Vanguard mutual fund, and for $50, all of a sudden you're spread out across the whole stock market. But as far as when do you actually make the decision? So those are some of the examples of what you put your money into. But then the decision that a lot of people don't even consider is, when do you do that? Most people, when they want to put money in, they just do that, and they don't really think twice about it. They don't necessarily look at the fact that there are trends and movements in the behavior of individual stocks and companies. But there are methodologies to use to help time, if you will, or help you make a good decision as to when to put the money in. And the two major schools there is called fundamental analysis and technical analysis. And we'll, I think on the next slide, look at both of these a little bit more. Like I said earlier, your generic investor is a buy and hold person that's going to buy something and hold for decades. If you have an investor that does some research on their own, chances are they are, by default, a fundamental analysis type person. And like I said, we'll get into this, but that's the majority of investors. Technical analysis is used far more with your active type traders. So if you recall, I was talking about swing traders and day traders. Those types use technical analysis far more. Some don't use fundamental whatsoever. But technical analysis, just real quick as an introduction to it, is the line of thought that the price of a share of a stock and how that changes, as well as volume of the individual stock, so how many shares are bought and sold of it, tell you everything you need to know, or the majority of what you need to know. Everything is baked into that share price of that stock. So if it's going up, that's all you need to know. You know that there's value there, and if it's going up on high volume, that means a lot of people are trying to get it. They're trying to get in. So that makes that move up in stock mean that much more to them. So they don't necessarily ever glance at an income statement or look at any sort of ratios or profitability. They're going strictly based on what they see in the stock price chart. So it's really interesting, and there's many books obviously on both of these approaches. Any questions on this one? Okay, so to explain some of this a little more, I wanted to delve into the top part of that last slide, so mutual funds and ETFs. So like I was saying, this is an avenue to diversify your accounts by, instead of having to manually buy dozens or hundreds of different types of shares, you can buy a small handful of a mutual fund spread, for example. You get a mutual fund that focuses on American big companies, American large caps, or you can go, there's international mutual funds, so you can invest in emerging markets, so what we call the third world, so developing economies like South Africa and Brazil. Or you can go an income route, so you can get mutual funds that focus on getting stocks with really high dividends, so they can give you nice distribution checks. So there's all different ways of doing that. But mutual funds came about in the 1920s, so they've been around a very long time. ETFs, on the other hand, which again I'll explain the differences and similarities, are much newer, from the 1990s. And you'll notice on the left side, this simple bar chart here is showing the largest mutual funds as of when I pulled that. So on the very far left, Vanguard Total Stock Market, and the stock symbol is right there. That's the biggest mutual fund there is. And you'll notice that those bars are much bigger than these bars for the ETFs. So ETFs are newer, smaller, but growing in popularity. And there's many types of all of these. So you could have a very diversified account by having 5 different ETFs or 5 different mutual funds and be covering all your bases: international, domestic, large cap, small cap, however you want to slice and dice it. But they're very convenient. Do all of you know some about mutual funds or have been involved with them in the past? Feel comfortable with them? Yeah. It's kind of the generic way of investing. A lot of 401k type programs for employers just automatically will dump you into a mutual fund, like Paul's and mine are dumped into one single mutual fund. One choice, I think, as far as I'm aware. So as far as what the differences are and similarities, this is something I don't think that the vast majority of people know. They kind of see them as interchangeable. So this graphic I pulled off a website that was actually advertising ETFs, but I put my own little boxes of kind of my comments on that, so I don't necessarily 100% agree with how they were coming about it. But starting with the similarities, so on the left-hand side, in the very top left, diversification. So like we've kind of been talking about, these are both good ways to get involved with a lot of different securities, a lot of different stocks. So they're very similar in that regard. The next one down, professional management. So this is where I would disagree with this graphic. Both are managed, so there are people at the helm pushing the buttons and making the fund or the ETF work. But ETFs are much more hands-off. So if you were to buy a mutual fund, most likely you would get a prospectus in the mail. So it's an informational packet of past performance and current holdings of that mutual fund, for example. And they'd most likely have some black and white pictures of 5 guys that are the fund managers, they call them, in a little bio about how many years they've been working at Vanguard. Those guys, though, are making the decisions on what that mutual fund holds. So they're actually buying and selling based on their inklings on what's going to happen, how the market's going to behave. ETFs generally are much more hands-off, where if you were to buy, for example, this one right here, this is an ETF of the entire S&P 500. If you were to, I'm sorry?
So that's the one I usually focus on.
Oh yeah, that's a very high volume one. If you were to buy that, you are going to have little bits of those 500 stocks, so you know what's there. You don't have John Doe deciding I'm going to pull my money out of GM and put it in GE this month because I think that's a better bet. So that is a difference that I disagree with this graphic on. Risk and reward, generally the same. I mean, you have the diversification, so you have lower risk than just buying a single stock, for example. Now the difference is, I think, is much more mysterious to people. So on the top right, it says cost, and because we have these, people being paid 7 figures and huge support staffs on the mutual fund side to more actively manage and get their hands on the fund itself, there are more expenses related to running that compared to an ETF that's more hands-off, like I said. So much lower cost. You don't have these, highfalutin Wall Street guys trying to run it. So the fees that you're paying, secretly paying, they don't write you a bill that you have to mail a check in for your mutual funds, but they're skimming money off to pay these fees. The fees for the ETFs are generally much lower than mutual funds. So that's one difference and something definitely a benefit to going the ETF route. Fund performance, partially because of those lower fees, ETFs generally give mutual funds a run for their money. And what's interesting is that rarely do you see mutual funds outperforming the general stock market. And there's actually been studies where professors have, there's a saying, I forget where it came from, but that a monkey throwing darts at the New York Times ticker stock page would be a better way to invest than trying to pick stocks. And there's been studies where professors have completely randomly built portfolios as if a monkey was throwing a dart at the stock page, and it's outperformed over decades the mutual funds in the general stock market. So the fact that ETFs are more hands-off, I think, is another way beyond just having the lower fees, that they have the potential of outperforming. And actually just came across, to continue this tangent, another article recently that somehow from those black and white photos in those mutual fund prospectuses, they estimated the amount of testosterone of the fund managers based on head width or something like that, and found that the more testosterone the fund managers had, the worse the funds did, because they were more into gambling and not being as cautious. So you have like human intervention like that, and human behaviors coming to play, and obviously not doing as well. Buying and selling, this is a little more complicated. We don't need to get into this. All you really need to know is it's slightly easier as far as transactions go with ETFs. They are bought and sold more like a stock is. Mutual funds are, like for example, if you own a mutual fund and during the day, like Paul was mentioning, he saw his portfolio go down today. If you were to look at your mutual fund listing on your Fidelity page, you might notice that it doesn't move. Only after market closed are they updating the price of that. Whereas if you had like the SPY or another ETF, you'll see that it's continuously moving just as the basket of stocks that it has, the prices of those are moving. So you see more in real time what's going on that you don't have that visibility with a mutual fund. And then knowing what you own, the last one there, if you have an ETF, you know exactly what it has. It's as being more hands-off. I shouldn't say exactly, but it being more hands-off, their holdings are more sticky, they stay longer. You don't have the managers making decisions and moving money here and there, so you know more so than a mutual fund what's there. So have any of you kind of thought through this before or wondered the reason why there are ETFs compared to mutual funds? So,
I know
yes?
my dad actually turned me onto all the ETFs.
Really?
He said always is winning
Yeah.
more so. And then they owned the same thing, but there's some other, one of his brothers was in charge of a union thing. And they paid the guy quite a bit of money. And the standard S&P beat him
Really?
all the time.
I know, it's terrible. You pay money to not do as well.
Trying hard and not winning.
Yeah, I know, it's rare. Even Mr. Buffett himself, I don't think, does necessarily that well from what you see of his performance. Yes?
You mentioned Vanguard, which that triggers me because that's who we use.
Okay.
Employer. They have both, right?
Yes, yeah, so even on the top 5 biggest, they have names on both of these sides of the slide. Yeah. There's tons of each type. So whatever type you're interested in.
I'm all pretty much in the mutual because I don't look at it much.
Mm-hmm.
So I'll look.
Yeah, great. Anything else? All right. So if you recall, let me show you what I'm referring to. So if you recall here, I was saying that as far as deciding what to invest in and when, there are kind of 2 ways to look at it. You can use one or both. But to give a kind of a high-level explanation of what these 2 are. So fundamental analysis, I mean, some people, when they make stock decisions, will go off what store they like to go to or what their favorite fast food chain is or some reason like that. Or if you have a small child, you might give them shares of Disney because they love Disney movies, and that gets their mind thinking about money and investments. And there's other ways that people decide what to pick. But the people that do invest with some kind of like deeper thought, if you will, behind it, typically will do one or more of these sub-bullets here. So fundamental analysis is, just as with technical analysis, is a very broad and kind of squishy term. And these are some of the major ways that people will go about it. So the first one there, financial statements. If you go to your brokerage or by law, if it's a publicly traded company, which all of these are that we're talking about, they have to present their financial statements. So all you business owners out there know, so our financial statements include statement of cash flows, income statement, balance sheet, and you can look at all of those for past years plus management's discussion of those, so you can see kind of where management's trying to spin things or position the company. But you can look at those and try to assess, for example, are there favorable trends in earnings or sales? A lot of these quarterly earnings results that we're seeing come out over the last couple of weeks, they're all showing increases in profits thanks to the corporate tax cuts, but not necessarily, I mean, in some cases, of course, but not always growth in revenues in the top line. So that's a cause for concern. So you would expect, the bottom line to grow with the tax cut, but you would hope the company is organically growing as well with revenues. But you would be able to tell that by looking at the financial statement. So obviously, a very valuable source of information. Ratios, and there are many, many of these. I highlight one on here that's common and I think helpful. It's called the price-earnings ratio. So ratios, what they give you is a way to distill all the stuff that you're seeing in the financial statements down to something that you can compare company A to company B. So it's a way to make it, to help you in your decision making and make that much more easy to do. So the price to earnings ratio, before I was saying for our example company here, if we have a $100 share, say the total, I think I said 10 shares, I think. Say the total earnings of this company is just 20 bucks per year, and we have 10 shares, so that's $2 per share of earnings, if you broke it down on a per share level. So this ratio, what it does is it takes the price of the share, so our $100, divided by that particular share's portion or proportion of the earnings, so our $2. So 100 divided by 2 would be a price to earnings ratio or PE ratio of 50. And then you could compare that ratio to company B's ratio, and that's a way to assess, is the current price of company A cheap compared to either the historic norm or trend of that stock, or compared to, say, one of its competitors. So if you wanted to get involved in utility stocks, you could look at the PE ratios of all the major companies in that sector and see which one at this moment is the best price according to this measure. So that's one way to do it. And this graph here shows historically, going back to before 1990, I'm not sure exactly the year it starts, but you'll notice that the line fluctuates back and forth around 20. That's kind of the long-term historical norm, so a PE ratio of 20. So that's saying that for every dollar of earnings that your share has rights to, if you will, you'd be paying $20 in share price, on average, according to the whole market. And the gray vertical sections are actually recessions. So you'll notice the numbers, or the graph spiking in these two at least. That's not that people were paying more for stock at that point, but that the denominator, the earnings per share, were just cratering. So driving up the ratio to, in the 2008 recession there, up to 120. So far, far above kind of historical norms. Have any of you used that before, PE ratio, or come across that in Fidelity or whatever you use? Yeah. I think it's easy to understand, and it's a way to assess if it's a good time to get in. Dividends, so a lot of people will assess stock based on dividend yield. So that's there are dividend investors, and there are some really interesting blogs that some of these people have where they will show you every month their results of their stock, so how much in dividends they brought in, so you can see the growth, and they provide short lists of companies with high dividends that they recommend. So there are a lot of people that are dividend investors, what they call themselves, and I think they have some other names too. But that's obviously a big benefit to owning stock, is that you have this cash income coming in. And I know years and years ago, they used to call dividend stocks like widow shares or some term like that. And widows would have these dividend stock holdings and live off the dividends. So there was a source of living for people. I don't think people do that necessarily so much anymore, but there are some very good dividend paying stocks. So fundamental analysis will also involve trends, and also trends of the industry itself, or sector itself. So you might look at just overall, do you believe that the tech sector is going to be doing well in the upcoming years, or with driverless car technology, is this going to be good or bad for the automotive industry? Let's try to figure out what the trends may or may not be from that, and kind of invest appropriately based on that too. So there's a lot that I'm leaving off here, but these are some of the major areas that people will look at when they do quote-unquote fundamental analysis. Any questions on that? No? So the other of the two, technical analysis, there are so many books on this, a lot of really interesting ones. But like I was mentioning before, it's based on the theory that the price of the stock and the movement and volume of it distills all the information that you need to know about that stock. So whether it's a good or bad earnings release, or poor financial health, or whatever the case might be, or headwinds for the sector, for example, that will be known and baked into the price of the share. What's really interesting about technical analysis is that there are hundreds of what they call indicators or tools that they use for trying to time the ups and downs, the peaks and valleys of stock. So one way that they look at this is through some magic lines that I want to show you here. So we have three types of these invisible lines that you'll see on the stock price chart. So again, this is kind of the information they use, plus tons more. But I think this is a very easy, simple thing that anyone here can do immediately as you start making decisions. If you pulled up any single stock chart, you would be able to, after you kind of see what I'm about to say, easily tell where these lines are. And it's amazing how they work. At least I'm amazed, being a finance geek. But so this first one, these horizontal lines, this is support and resistance. So I'm going to get in front of the screen a little bit here. So this bottom red and green, this is volume. So how many shares are bought and sold in a day. So just put that aside, ignore that. But this line up here, this is the price of this particular stock. Applied Materials, they make chips. Jim, do you know Applied Materials? I think they make components for electronics. And the height of the bar is how much the stock price moved in the day. So if it started at $100 and fell to 99, you would have $1 height of that particular line for that one day. If it moved $5, it would be a much taller line. The green lines are where the stock price went up from the start to the end of the day, and red lines are vice versa. But what you'll see here, so starting back in April of, I think it's 2016 or so, the price comes up, and then for whatever reason comes down. Then it kind of hovers above here, and for a few days it stops here, exactly stalls where it dropped from before. So what this is that there is a line of what's called resistance there. That's a line that's holding the stock down. The stock is bouncing off this and not going through. However, it finally breaks through, and what's really cool, I think, and this is just human psychology, because there's nothing magic behind this other than how stock traders are playing this. It breaks through the line, and then later on, it comes back down, and what previously was holding the stock down, being resistance, now supported the stock. So it was now a line of support. So you'll see it bounced off that exact same line at roughly, I think that's $40 or so. It's a little fuzzy here. So it supported the stock above that. So the purpose of these lines will flip based on if it can break through or not. So once we break through here, again, we hit some unknown point, come back down, bounce off our old resistance line that's now supporting the stock higher, comes back up twice, hitting that same exact spot. So here we know now what our new resistance line is. Eventually hits it again, and it comes through. And so you see how that plays out. But just looking at the stock price chart on its own, not thinking that there are these kind of lines in play, the movement will look very, very random. And of course, there is a ton of randomness to stocks and how they behave, because it's not very predictable like we saw today. I was telling Jim earlier, at the start of today, Caterpillar announced really good earnings for the quarter, and I think they started the day up 4%, and by the end of the day, they're one of the very bottom stocks of the whole pile. So this doesn't make logical sense always, usually. But this kind of helps you at least have an idea of where stock prices might change. So you'll see if we're about to hit a line of resistance, you should think, do I want to gamble that this time, at time number 3, we're going to be able to break through that point and go higher? Or should I wait to see if this is another example like these two, where we're going to bounce back down? Maybe I should wait to see if we bounce back down, I'll wait and try to buy again where we hit this support. Or if it breaks above, maybe I'll buy up here, because then I'll know what was previously holding us down may help hold us up. So that would be potentially a good time.
Two lines represent in a sense, the collective wisdom of the
Right,
investors in
wisdom.
that stock, saying it's worth at least this much, but no more than that,
Yeah,
for now.
according to known
Maybe they'll decide,
insight.
oh,
Yeah.
well, maybe it's worth more, or
Yeah.
it's worth less
Yeah, exactly.
than that range. So it's basically the collective wisdom range.
Yep. And there's, so we're gonna talk about 3 of these types. So this is the first type. But as I mentioned, this technical analysis goes so much further, and there's really weird stuff. Like, I don't know if you've heard of Fibonacci ratios. Does anyone know what those are? You can provide the definition, anyone? It's some mathematical ratio, and I forget what it is. So if anyone knows it, shout it out. But it's found all in nature as far as like ratios of the swirls or twirls in like snail shells, for example, and all over across like God's entire creation. And you see it in stock price movements too. It's so wild. So it'll actually reverse course or bounce off these Fibonacci ratio lines too. So it gets crazy, but these are a few ways to just very easily, without having to figure out what the definition is of that ratio, to use this.
So how would you put those lines on a chart if you were on your account?
Well, you could, like for example, I use Fidelity, and there is like a graph that can pop up for any stock or ETF or mutual fund. And there's a little draw function where you can click to start your line, and you hold the mouse down, the left click somewhere else, and that draws a line, vertical, horizontal, diagonal. Or you could print this out and draw them on manually. Does anyone else use charting software of any sort? Yeah? Yeah. So you do the same thing, or have you used any indicators?
They call pivot points.
Yeah, pivot points, yeah.
They're interesting.
Yeah, absolutely. Yes?
Do you do much, or as far as with Elliott wave theory?
Yeah, I've read some on that. I've never put it into play.
It's kind of, actually, it's kind of interesting the way that.
Yeah.
It goes, there's 5 basic waves to stock movement. There's one, and each wave is successively higher.
Mhm.
Where you can like time them. It's really weird, but
And aren't we overdue for a correction according to that, I think? Yeah, I think we're long overdue
yeah.
for a reversal of it all.
Aren't the historical ratios out of whack?
As far as valuations of
Yeah.
stock? Yeah, a lot of people are arguing that
And they've been
we
out
are
there
too
for a
high.
long time.
Yeah, and I don't know this. They stopped labeling this chart in 2015, but a lot of people will say that we're just from the PE ratio alone, we are overvalued. Things may change now with the tax cut and the economy picking up more. Companies are more profitable now, so perhaps that will have some more fuel, some more go for this current bull market. But since I forget when in February we had that first big correction, but it's kind of been going sideways since, which is good for things like options, like we'll talk about later, but not good if you're buy and hold necessarily, unless you think it's going to keep going up. Yes?
So if we're at a candlestick approach.
Yeah, candlestick, yep. That's
But it's so hard to predict a peak, so you can get that quick short. And
yeah.
do you have any methods you use to predict it?
With candlesticks?
Yeah.
Well, personally, I've never gotten into that aspect of technical trading. So what he's referring to is, well, to some degree I have, but it's really hard to see on here. But these particular bars here, like I said, are the height of the range of the day. There's another version of this view called a candlestick chart, and there's no chalkboard, right? That's you'll see a filled-in vertical rectangle with a line going up and a line going down, potentially. And the big box shows the starting price of the day, the opening price, and the closing price. So that's filled in, either red if it's a down day or green if it's a good day, or if it's in black and white, one would be white, one would be black. And then the lines going out, they call them whiskers or wicks, are showing the full range of the day. So if it started at $100, went up to $101 by the end of the day, but in the meantime, it went up all the way to $105 and all the way down to $95, you would have these wicks going from 105 to 95 in a big rectangle between, 100 and 102 or whatever I said. So a whole realm of technical analysis. So this is where it gets all into psychology and weird stuff, but is about patterns of these candlesticks. And it comes back to, I forget what century, but a rice market in Japan. Some rice trader developed this, and here we are today talking about it in this century about Google and everything else. But how those candlesticks look theoretically can help tell you where you're about to hit a peak and come back down, or vice versa, or a strong up move. And there's cutesy names for different patterns that they use. Like a doji is one where the opening and closing price of the stock, so instead of having that big rectangle, are actually dead on almost, or really close on. So they'll look at that as a potential point of reversal. So if it's going up, and you see one of these quote-unquote dojis, there's a lot of Japanese names given where it came from, they would expect potentially the stock to come down, and vice versa. But yeah, I know there's all kinds of patterns like that for using those. But
yeah, if you want to put a short in, it's kind of terrifying.
I know.
You know you can get burned way more than
Yeah. Do you short stocks?
not yet.
No. Yeah, it's scary. Yeah. So I've never shorted stocks, but getting into options, it's you can very easily make that same bet, betting that the stock's going to go down, or you can place your bet that you don't necessarily care where the stock's going to go as long as it stays within a range, and it could be a very wide range. So you can play the market different ways without having to kind of take that leap and shorting stock, which is a little scary. Yeah, there are all kinds of inverse and leveraged ETFs. You can get really fancy and it gets complicated, but you don't need to know that getting started. I think I saw one more hand in the back. No? Okay. So the other two ways I want to show you today that you can see these magic lines at play. The top one shows that very, very often when you have a stock going up or going down, that's what's called a trending stock, you'll see that, like for example, this middle set of parallel lines there, it will bounce from one, bounce up to the other, that parallel line running up or running down, and come back down and bounce in a channel going up or going down. So it gives you an idea of where you might see a price reversal going up or going down. So if you know you wanted to buy AMAT and you're right about October here, generally you're in an uptrend, a very good time to buy would be right when it's coming down again to this diagonal line, the lower diagonal line. And buying there is what a lot of traders will do because it's a little more assurance that it's not going to keep falling. It's going to bounce up at least temporarily. And then vice versa, if you wanted to go short in a stock, you would wait till it hits the top line, and then there's a slightly higher, higher chance that the stock will bounce back down. But it's amazing when you start seeing these patterns. I don't know if you can see, like right about here, that little tall red one there, that even explained why did the stock stop there. It went up so high that day. Why did it stop there? And the answer is there was this invisible diagonal line there that was forming the top line of that channel, and it hit it, and it bounced back down. It wasn't strong enough to keep going through. So it helps you understand a little bit more why prices do what they do, that there are these other things in play. And then down here, the last type I'm going to share with you today here is called moving average lines. So in your Fidelity charting software, you can drop in moving averages, which just simply is a simple moving average would be taking the last X number of days, dividing the price, and putting that point in the line. There are other types of moving averages like exponential moving averages, but we won't discuss those here. But here you'll see an example of a moving average. So this squiggly line here is the 50-period moving average. So it's looking back 50 days, 50 trading days, and figuring out what the average was and plotting that. You'll see here at the points I circled where this 50-day average is coming into play, where the stock's either bouncing up from it or bouncing down from it. And I listed on the bullet to the left the major moving averages that a lot of traders use. And when you see big volume traders using a certain indicator, that means because of all the money they have and they're putting into play, that actually will affect how the stock behaves. And you see that here in those circled sections where things are bouncing off them. So, inexplicably, if you didn't have this line, you would have no idea why it's behaving exactly to that line. And the longer the period of the average, so a 200-day moving average is a long one, a 10-day is a very short one. The longer the period of the line, the more strength it has. So a 200-day moving average line carries a lot more weight than a shorter term one. And you'll see, like for example on CNBC, if we come to the point where stocks are starting to fall through or go below the 200-day moving average lines of their prices, that's a very, very bad sign. That's a sign we're most likely going into a bear market. So you are seeing some stocks flirt with that now. But breaking through or breaking above one of these lines means something. And it can affect how the stock plays out as well. Does that make sense? So it's pretty cool, I think, at least, that there's these lines that you can't see.
Do these things always follow?
No.
Is there a chance that it could do the exact opposite you expect?
Yeah, I'm trying to see if there's an example. So, I mean, back here, like I said, that day in February that I can't recall the exact date that was so terrible. Like, it did come down through this line for a few days, but it went back up. You don't necessarily know, for example, when we test the line, when it'll go through, because here we had 1, 2, 3, 4, and on the 5th time it went through. Whereas here, we kind of went through on the 2nd time. So there's not necessarily, on the 3rd try, it's always going to go through. You never know. Some people will use the amount of volume. So again, I said, the share price and the volume is what a lot of these technical traders will use. So if you saw the stock price come up to the line and there was a ton of volume, so this volume line just shot up, that might have given enough gas to that fire to push it through. But if it was a test, it's what they call a test when it hits the line, with low volume, low investor interest, that most likely would not have the strength to push through that point of resistance. So that's one way to do it. And plus there's other indicators that they use too, but you never 100% can know. Yeah. Is that pretty cool? I don't know. At least geeks like me think it is.
Kevin, it would be interesting to see what the other stocks were doing, like on that February day. Because just like you said, Caterpillar started out with a good earning report and 4% up, but then the stock market was down 500 points.
Right.
So what was going on in that day with the general market?
Right. Yeah. So there's a lot going on behind the scenes that you don't see here. Yeah. So a lot of politics and rumors of trade wars and real wars and all sorts of things that are also moving these around. So I think, unless anyone has any questions, that's the kind of like the 101 stock introduction, mutual fund introduction. So I think that was a lot of information, especially if you haven't really invested much, but hopefully that made sense. Any last questions on that part?
One really basic question.
Sure, yeah.
So every time something bought or sold, somebody is buying or selling.
Mm-hmm.
So when you get a big fall and everybody wants to sell or everybody wants to buy, how do they always put the buyer and seller together? Who's the pool?
Yeah, so what's interesting is, so like the day trader types, they use trading platforms, so like a supercharged version of Fidelity, for example, that actually shows, I think it's called level 2 quotes. So it shows if you wanted to put a buy order in and someone else is trying to sell, it'll show on two sides of this box the individual orders of how many shares that someone's willing to buy and at what price and how many people are willing to sell at a different price. And you can see if one side's stacking up with buy or sell orders, out of proportion to the other, that's what's really moving the price one way or the other. It's just supply and demand. But yeah, there's a whole other world of what are called like market makers and how they put this all together. So it's kind of a big black box. That's how that works. Yeah, but those level 2 quotes are interesting if you ever can take a look at that just to see just a flurry of stuff moving around.
So an elementary question. So whenever you sell your stock on Fidelity, and you get the notice it was sold,
Mhm.
it could be, 4 or 5 days before that money is cleared.
True.
To put it back in your account.
Mhm.
Do you have to wait for that money to be cleared before you can buy another one through Fidelity, or can you go ahead and do it after this, you've got the notice?
I think that would depend on the type of account you have. Like there are accounts that are margin accounts. So to trade options, which I want to introduce next, you need to have, to do certain types of options, you need to have margin. So if you had a sale and the money hasn't yet cleared with a margin account, you could still play with that. But potentially with like a more cash settled account, you might not be able to. You might have to wait. So I think it would depend on your account and brokerage.
It depends on things like your credit rating, how much money you've got, your history with that company, a lot of things.
You have to get approved for a margin
Sometimes
account.
I want to turn around and buy something right away, but I'm going, it's not been cleared yet.
Yeah.
You know what I'm saying? So I have to wait 4 or 5 days, and then it's
Right.
the opportunity that I thought was there is gone.
I know.
That time.
You gotta
Yep.
keep some cash in there.
Borrow some money from Paul.
There you go.
That's the break in my mind, she'll buy some car. All of them.
Oh, funding, yes, sir, I got some.
You know where he is at least once a month,
Yeah.
right here. Is it every week or every month, this meeting? All right, so stock options. So like I mentioned, last year, over my lifetime, I've been involved in swing trading. I tried day trading. That's too stressful for me. It's not my appetite. Buy and hold. So in college, I linked up to a Edward Jones guy, and he got me started in mutual funds. So I started off kind of the traditional route. And last year, I really got into stock options, and I read thousands and thousands of pages, listened to probably dozens or hundreds of hours of podcasts and YouTube videos, and started small with them. And the reason it took me so much research to get started is it sounds scary, and most people don't know anything about these, and just like the name kind of makes it sound risky, or that there's something weird, especially when they throw terms out like derivatives and stuff like that. So it sounds dangerous. And does anyone know what movie that's from, by the way? Wall Street, yeah. I'm a fan of 80s business movies. But they're not necessarily as scary or dangerous as you might think. There are very risky ways to use them, but there are also very, very conservative ways too that I got Paul interested in very recently, like covered calls, for example, which is an approach, an extremely conservative approach with really, there's zero downside risk to it. It's actually some protection to the downside, so it's...
More conservative than just buying the stock.
It is, yep.
Or the ETF in that case. So it's like,
Yep.
buying an Kevin talked me into buying an ETF and then doing a covered call on the ETF. So it was like really safe.
Yep, absolutely. So there are, of course, just like with stocks, you can buy GE or you can sell GE short and go short on it, which is a riskier way to play that. But I wanted to just maybe whet your appetite on stock options, and if this sounds interesting like it did for me, maybe you can go and research more. This kind of was the happy medium for me on risk and having enough activity to keep me interested. And so buy and hold I thought was too boring. Day trading was far too stressful. This is kind of this strange happy medium. Just wanted to give you a little background on what they are and kind of how they differ from stocks. So stocks, like I said, I thought or mutual funds in particular, were a little too slow for me. You would buy them once and then 40 years later sell them. So 2 transactions over a working lifetime. Thought wasn't as fun. But options kind of can juice leverage a little bit to make it a little more interesting. So for example, and we'll get into all the terminology, but one option, they'll call it a contract, but one contract, an option, actually is for a temporary period of time controlling 100 shares. So one call option, and we'll define it shortly, is over 100 shares of Pfizer or whatever the stock might be. So that obviously is some leverage that can help if you're trying to get a higher return than the monkey throwing the darts at the the New York Times. It is possible to actually use these safer than stocks to generate less risk in that second bullet there. For example, if you owned a stock, like that AMAT that we had up there for the last discussion, and it cratered, like we actually saw. Like it dropped down like this here in this very bad couple weeks here. There are things you can do with the stock. You can enter a limit order, what's called. So if you bought it up high and you said, I'm willing to take a loss of X number of dollars, $5 a share, you can have your brokerage automatically place a trade if that point is breached. So if our $100 share of stock went down to $95, Fidelity would automatically try to get you out of that stock. So you'd have a $5 loss in the stock, but it could be better than, $10 or more or whatever if this was going bankrupt. However, with that sort of order, they can't force someone to sell it to you at that $5 loss point, that $95 point. But with an option, by the terms of the contract, you would exactly get what you had put your option in for. So it's you can be more exact in your stop loss points at the points at which you're willing to get out and take your losses and try again another day. So that's another interesting thing, one of the ways you can limit risk with them. They have higher potential returns. So there's a number of ways to look at that, but I'll just leave it at that. You can get bigger returns than just investing in stocks alone, and that covered call example that we'll talk through is an example of that. How you can have your stock, you can keep your dividends, and here's a whole other income stream, these calls that you can put on this, you can sell from your stock as well. So that alone, not counting all the other ways to use options, would juice your earnings. And they have a lot of alternatives, that fourth point there. They're extremely flexible. It's not just, I'm buying GE today, I'm selling it next year. There's a whole suite of things that you can do with them. So, what are options? So options, there are two types. There are, it's like these turquoise boxes at top. There are what's called a call and a put. And the definitions are underneath and are really important to understand. So a call is the right, so not the obligation, but the right to buy what the call is on. So in our discussion here tonight, on stock. So the right to buy a stock at an exact price, a particular price, for a certain period of time. So it's not indefinite, like theoretically owning a stock would be, unless it went bankrupt or merged with a different company. But for a specific period of time. So that's a major difference from your typical approach to investing. A put is the opposite. So it's the right to sell for a certain amount of time at a certain price. And that price at which you are either buying on the call side or selling on the put side is called the strike price. Or some people say, an exercise price, but that's an important term. So our strike price is the point at which we're either doing our buying or selling. What is extra cool, I think, about options is that typically when you want to invest in a stock, you're buying it and then eventually selling it. There are some adventurous souls that go the other way and do that sell short thing that we won't talk about. But for options, you can, in the same way, you can buy a call option or buy a put option, or you can sell one that you don't already own, that you haven't already bought. So in essence, you're actually creating an option by selling it. You're what's called writing an option. So you can either buy an option and then sell it, so you can do both of those, or you could go opposite and sell one, you're creating one, and then to close out your position, it's kind of confusing, but you're buying it back. You're just doing the opposite to cancel it out. But that, I think, is really cool because it's almost like you're creating shares of stock. You're creating put options or call options. And it's a completely different way to look at it all. Has anyone ever traded in options or researched them? What have you tried? Buying or selling?
So about 25 years ago, before I had children,
Yeah.
I got involved in that chart trading thing, and I would wait, every week I would get a new set of charts on commodities.
Oh, commodities, okay.
When you had to pay like $150 a turn at every.
Oh, wow. Now it's $1.
Almost everything you do. And you have days where you, back then, you make $4,000 or $5,000 a day, and then you lose $1,000 every other day.
Yeah.
And, you know, they got to learn.
So you were a buyer of options, I assume then?
We tried it both ways.
Oh, you did? Okay.
You're just kind of blindly going there, and
Yeah.
the broker's looking to sell you anything anyway.
Yeah.
Yeah.
Yeah. Now the commissions are far, far less. I think commodity future commissions are a little more, but a stock commission on an option is $1 now in certain brokerages like I use. Yeah, so it makes it much more affordable to get in and out.
And who do you use to do this then?
Tasty Trade? Yeah, I'll show the link at the end, but it's called Tasty Trade. Yeah.
How do you determine who to trust as far as dealing with options and buying and selling options?
Well, the buying and selling, just as with stock, it's done on a brokerage platform. So it's not like I'm on a piece of paper writing out a call option and I'm delivering it to you and you're paying me money. It's just all done electronically, just as buying Pfizer stock. Is that what you're kind of saying? Where you think it was more manual, maybe?
There's thousands or hundreds, at least, of different companies out there
Right.
doing stock options,
Mhm.
and they all promote that they're gonna they make 80% of their trades are good trades.
Oh, yeah.
But in reality, they never deliver.
Right.
So
Yeah. You're talking about like those paid services where you pay me money, I'll help give you advice kind of thing, those
how
websites.
do you determine, as far as I have options, is, who's good to work with?
Yeah, I don't use any paid services. I just make the decisions on my own. But generally what I do, and we'll get into this, but there's different ways you can use options. So you can have a view on the market. So you could say, my opinion is that stocks are moving up, that we're going to continue this bull market. Or you could say, you could be bearish and say stocks are about to go down or in the process of going down. Or you could be completely neutral and still make money with options. So you can say, I don't care where the market's going as long as it doesn't move crazy amounts either way. Like the last couple of months, it's kind of been bouncing, severely bouncing, but in a range. You can still make money with a neutral play, which is a really interesting way to make money. So, yes?
Okay, so I'm still trying to get definition.
I know, it's confusing. It takes a while to learn.
Okay, so going back to fidelity.
Yes.
If I buy more than 100 shares
Mhm.
of something, I then have the option of setting the price that I'm looking for or selling it. But that's not the same thing you're talking about now.
So say you bought 100 shares of name a stock.
If it's below 100, I don't get to choose the price. I got to go at the going rate.
Well,
But if it's
so
over 100, I can say if it hits this price, I'm going to buy.
Mhm.
Or if it hits this price, I can sell. That's not what you're talking about when you say options.
no. So an option is not stock. So like for the example that with Paul we had, so Paul bought 100 shares of an ETF of NASDAQ. The symbol is the Qs they call it, so it's 3 Qs. So I buy, let's just say, $10,000 of an ETF for a stock. That's in my account. On top of that, separate from that, I can have an option. I can sell an option based off of those 100 shares of stock. So it's separate from that. You still own the stock in that covered call case, but
You have to have 100 shares of that.
you need, just because by definition each of these controls 100 shares of the underlying stock or ETF, it has to be in 100 share increments. So you could own 120 shares, but you'd still only be able to sell one option off of that.
So you have to own at least that.
At least 100.
shares to do this.
Yes.
In
Yeah.
blocks of 100.
So once I own
Yeah.
100 shares of a stock,
Yes.
I can do ETF.
You could sell a type of option, a covered call it's called. We'll get into that in a little. It's confusing. One way that I learned what is a call and what is a put, because one's buy, one's sell. Call starts with C, buy starts with B. Those letters are very close when you sing your ABCs. P and S are closer on the other end of the spectrum. So put means to sell. Yeah. So that's how I remember what a put call is, what a put is. So so if you going back real quick to here, so we have calls and we have puts. So the right to buy and the right to sell. And these two types of options, we can both buy and sell them. Okay, so we have a little more flexibility in that. However, you are not limited to just, say, for example, buying a call option, one of them, or selling a put or buying a put one at a time. One really interesting thing about options is that there are different strategies that involve more than one option at a single time. So these are just a very small handful of many strategies that there are that involve more than one option. And a lot of them have really cool names, like iron condor, there's butterflies, strip straddles, long calls, based on what you are thinking that stock or that ETF or the overall market is going to do. So if you think the market's going to go up or that stock's going to go up, these are a few of the ones that would be applicable for your mindset, for where your head is on what's going to happen. If you think the stock's going down, there's a whole nother set of things that can help and that would make money if the stock went down. There are the neutral ones. I really like, and I've been playing a lot with these, strangles, which is a neutral strategy. So as long as it doesn't go straight up or straight down in a certain amount of time, I'm great, I'm good. And then there's specific strategies as well for if a stock is just going crazy up and down. That's called what's volatility. So if it's really high volatility, there's ways to deal with that as well. But this just kind of shows you just a little hint of how much flexibility the options give you to play. It's not just buying Pfizer, selling Pfizer 40 years later. It's you can play the market different ways and make money different ways depending on if it's a good up market or a bad down market, for example. Have you ever heard of any of these? Iron condor is probably the most famous of all of those. So, but there's all kinds of funny names. And they keep coming up with new ones too, like iron fly and all these different ones. So that's just some of the general definitions, and then just kind of an overview of kind of how they can be used based on, like I said, your view of the market. But as far as what affects them, so like for example, if we have a share of stock, we have a good idea of what would affect the stock price. So if General Motors came out tomorrow with a really good first quarter 2018 earnings, or they came out with something that proved that their electric car technology is better or more efficient than Tesla's, we would assume that the stock price would go up. That's kind of how we would view that value in that stock. Options are a little different in that they have a few different drivers of their value. So what would drive a price of an option up or down is based primarily, there are a couple other miscellaneous ones, but by far these are the three most important. So the pricing components, or the things that matter, are intrinsic value on the top left there, how much we have until that option expires. If you recall, I said we have the right to buy or sell for a certain amount of time. So how long that amount of time is a factor in the value of that option. And then the volatility of what we're talking about. So if we're talking about the Qs that Paul's involved with, how crazy is that ETF behaving? If it's flatlined, if it's moving from $100 to $100.50 and down to $99 and just kind of staying in a really small range, that's next to no volatility. So that would give us very little value. But if it was jumping from 100 to 120 down to 70 and all over the place, that would really juice up the value of an option. So starting at the top again, so intrinsic value. What's, I think, really cool about options is you can get like a money off coupon on stock, for example. So if we have a $100 share of stock, we could have a call or a right to buy for something even less than 100. So we could have a call at $95 that would give us the right to get $5 off per share. So if our call was at 95 and the stock's at 100, we have $5 of what's mathematical or intrinsic value. It's a $5 off coupon, so that's worth money, obviously. If it was going the other way in our $100 share of stock, we had a call of $105, no one in their right mind is going to pay money to pay more for the stock that they can get without the option. Does that make sense? That would be zero intrinsic or mathematical value. And the opposite too. So if we had a put or the right to sell for $105, 105 minus the $100 share of the stock, that's a $5 booster, kind of the opposite of a coupon. We would get a premium of $5. So mathematically, we have $5 of intrinsic value. The other two bars here are what's consolidated into what's called extrinsic value. So how long of that option's life is left is the time value. So if our option expires this coming Friday, that's a very short amount of time. So it would have very little value in that bucket. If it expires next July, that's a very long amount of time. So that would give us a lot more value there.
Because the longer the time, the more the chance.
Yeah, exactly. Yeah. Yeah, so if you have an option expiring Friday and our call is at $95, what are the chances between now and this coming Friday that it's going to move 5%? Much more minuscule of a chance than next July. The chances between now and next year of it going down $5 is much greater than now till Friday. So the last one is volatility again. So the exact same line of logic. The crazier the stock, the greater the chance that our price or the option strike price, if you recall the strike price is the price at which we can buy or the price at which we can sell, the greater the chance that we'll actually be hit by its wild swinging movements compared to a more flatline stock. So I know it may be confusing, but just want to give you this introduction and, like I said, maybe whet your appetites into learning more, because there's a lot that can be done here. Any questions on this part?
What's the expiration date on that?
They're set, so they expire with some exceptions, like the SPY ETF. They expire on Fridays. The bigger volume stocks, the bigger companies, the big ETFs, they might have options expiring every Friday. The lower volume companies, like Kimberly-Clark, may only have options expiring one Friday per month. So they are set by, I'm not sure, the powers that be.
Can you pick what date?
Yes, you can. Yep. And that comes into play in some strategies too. So.
But you have to own stock.
For certain strategies, yep. So for covered calls, I'm trying to see if there's any other examples on here. Generally, when you see something called covered, that means your position is covered by either having stock or cash in your account. But you can have what's called a naked option position, like the strangles and straddles and iron condors. They don't require that you actually own that stock or have cash, a lot of cash in the account, for example. Those are naked positions. So it goes both ways there. That's why you see, I guess I didn't put them on here, but you'll see like naked puts, naked calls, covered puts. Any other questions on that, on these definitions? Yes?
Yes. Have options always been available for the stock market?
No. I think they started on some volume, very small volume, I think in the 70s. And in the 80s, they started exploding in volume, and they've been kind of going up. Well, what was your name up there? Calvin. Like Calvin was mentioning, he was involved in options on commodities. So we're talking stocks here tonight, but you can have options on like farmers or food manufacturers may be involved with futures on whatever it is, whatever their raw materials are. So if you're a meat processing factory, you might be buying or selling cattle futures. So it's a way that they use to protect themselves from big changes in the price of cows. So they may use options and so forth and these futures to make sure they understand what's going on with their business. So I think that's kind of where a lot of the early volume came in. But now you can use them with stocks as well. So if you had 100 shares of GE and you wanted to protect against the stock plummeting. I mean, there's actually rumors now that GE is going to break up. You know, this major old American company might be split up. They're going through some tough times, and their stock price has been hammered lately. But if you wanted to buy insurance on your GE shares, you could buy a put. So if GE was, say, $15 a share, I think it's somewhere 13, 14, 15 today, you could buy a $10 put so that if GE went below $10, you had the right to sell at $10. So even if it went to zero, if it went bankrupt to nothing, you would still be able to sell your shares for $10. So with stocks, there's also, you know, legitimate, true reasons for using these.
So you're not actually buying the stocks, you're buying insurance on
Right.
the price of the stock.
You're buying rights to buy or sell. Yeah, so it could be insurance. Yeah. Yep.
That one's insurance. The one I did was, I don't know what it was called. I don't know some of the names, but basically just made a little bit of extra money on the stock.
Yeah.
It was a covered call that I sold.
Yep. Yep. Yes.
So a friend of mine, his brother works at Google, and as part of his compensation, he's given stock options to buy at a certain lower price, even though the price is higher. Is that, this is essentially a call option?
Yeah, you could see it at that, but it's technically different. Those are employee stock options, but I mean, the idea is similar. Yeah, like you can buy at a discount, like as if they were handing you a call. Yeah. Yes, sir.
Are you going to cover call and put credit spreads? Those I use almost exclusively.
Really? Okay, like vertical spreads, or?
They work pretty well.
Yeah, those are great strategies. Tonight I was going to introduce a couple beginner strategies like covered calls and then cash covered puts. But yeah, those are good too. I like those. Yeah. Any others? All right, so we won't get into a ton of detail here, and it's hard to see on here with the colors, but kind of how all this all comes into play. So we have, you know, a few different levers on how value is determined with options, and we talked about intrinsic value, so just the straight math on the value. So if we have the right to sell for $105 when the stock's for $100, it's a $5, you know, bonus in our favor. So there's, you know, real value there, and this is what's called an options table. Yes.
I'd like to make the process suggestion here.
Sure.
Okay, so apologies, but I'm going to interrupt. So here's my process suggestion. Okay, it's 8:30.
Oh.
Okay, so
It's talking too much.
here's no. It's 8:30, and I've learned tonight. So maybe what we do is do a quick explanation of this. Any other questions? We'll do a couple little things to close out, and then maybe we could impose on Kevin to come back and show us how to do some of this stuff. Like maybe we might even show exactly, maybe, what we did with the covered call that I sold that he talked me into selling. Because I bought the ETF, did a covered call, made $150 instantly. So, and
Not too shabby.
that just kind of protected against the stock going, or the ETF price going down. So how many would like to have Kevin talk us through it nice and slow in another session?
I would love that, I just don't want to put him on the spot in front of everybody.
Well, I kind of knew we were going to be drinking from the fire hose tonight, so I teed him up for that. And he said, hey, will you let me know when I run out of time? So do you want to look at the chart? We'll get it again next time, and then maybe have him come back in a few weeks, talk us through nice and slow how these option things work. And
Yeah, I could do that.
and maybe do a couple of the basic strategies, and then maybe, you know, something funky for the cool kids in the room. Is that good?
I would love to just explain what these resources are. because-
Oh, sure. Yeah. Yeah, let's jump to
It's
that.
like you gotta do the homework.
Yeah.
I get it.
All right, so one more Wall Street picture while we're at it too. These are, as far as learning more about options, a few resources that or two of the three I have found very useful. So option alpha, that first one there, it's all free. There are some paid things, but you don't need to do any of that. They have a lot of free videos and PDF mini books, I guess you could call them, that are free to download. You can do that on their website. But they go through some of their strategies, and this guy's a professional options trader, and he kind of talks through his logic and how he uses them. So again, you can do all of that for free. Tasty Trade is that brokerage I was talking about with the dollar commissions on options, and the screenshots, like that black one that was kind of hard to see, that was just on the screen. That's a screenshot from Tasty Trade. But there's two sites there. There's Tasty Trade and Tasty Works. They're like sister sites. And the guys that started it, I think, like 10 years ago. But they built out a huge active trader platform for TD Ameritrade called Thinkorswim. So they built this out. TD Ameritrade bought it from them, from these two guys, for like $750 million. And then they turned around and started this new company, this new brokerage firm. So in addition to being a platform for trading, they have every day, I think, like 8 hours of content. And they have a whole staff that does research. So they look at those different strategies on that table, like iron condors. And they look at all these different variations of, if you put this exact type or strategy of iron condor on every single week for the last 10 years, what would be the exact P&L, the exact profit and loss result? And they really are just super educational on what actually works, because they have this research team and somehow they do these big studies all the time. So I found that extremely useful. And like I said when we first started this section, even the term stock options, I had no idea what it was. It just sounds scary, sounds kind of different and new. But listening to all these numbers and studies really made me confident enough to try. Options Industrial Council, it's a nonprofit if you wanted to kind of see something that you might view as more, potentially not biased. Not that the other two are, but it's another one that they have some informational resources there as well. Once you kind of go through that and want to start learning, and you don't need to spend hundreds of hours and read dozens of books to get started learning more beyond just watching videos. But a lot of places have what's called paper trading, which is where you can play with fake money. You can open what looks like to be a real account and place using the real stocks, for example. Like the prices of the stocks are moving just as they are in the real world. But you can buy and sell these fake shares or these fake options and practice. So you can see, if I had done this in the real world, would I have lost money or made money? And you can see your paper trading account change accordingly. And you can play with different strategies too. But it's a way to just get comfortable with that. And then when you actually do start with real money, start small. That's what I'd recommend, and build your confidence and hone some strategies and how you play. But those are a few places to go to get started. All right, hopefully that was not too boring.